Hello and welcome to our market alert video for today, which is May 6, 2022. And I'm entitling this video, Are You Scared? Well, you should be. And I want to go over 5 reasons why, if you're over 50, if you are retiring soon, you need to really be looking, in my opinion, at your risk profile, at protecting what you have, given what's going on with the economy and everything else. And as we see it right now, there are 5 major threats to the economy, to the stock market, and potentially, therefore, your retirement as well. And I want to kind of go through all of those with you. And again, this is not to try to scare you or overly stress you out, but there's an old expression that the French have, which says, "Un homme averti en vaut deux." And what that means is that a person that is forewarned is worth 2. So I want you to be worth 2 people by forewarning you of the potentials that are out there and hopefully enabling you to think about what you should do. So first of all, one of the biggest problems that we have right now is that China is determined, even if it impacts our economy negatively, to have COVID zero. And they have basically, on Friday morning, President Xi, the president of China, came out and said, "Stop talking. We're not listening. We are going to lock down everything that's necessary to bring COVID to zero." Well, what they're doing by doing that is they're essentially affecting our supply chain, right? Because many of the parts and the products and all of the things that our companies here sell to us, the consumer, are made in China. And if all those people are locked down, then the products and parts to machines and all the rest of it is unavailable. If it's unavailable, then the companies in this country are going to have a difficult time making profits if they can't sell anything because it's all made in China and they don't have it. So that's a huge headwind, as they call it. The second thing, of course, is the war in Ukraine. And I've learned more about Ukraine than I ever wanted to know with this war, but Ukraine is one of the largest wheat producers in the world. And right now, from what I've read, the Russians are attacking their wheat fields. And of course, the farmers have other things to do besides farming right now. They have more important things to worry about. And so the ability for Ukraine to produce wheat is being impaired. And that could create food shortages. It could create hyperinflation in food prices if we haven't already seen that, and it could deteriorate. The other thing that Ukraine produces is phosphorus. And I did not know this. I was talking to a client. He's a farmer, and he has cattle. He raises cattle, which is where we get our meat from. And he said that the price of phosphorus has gone up so much. And what I didn't know is that fertilizer uses phosphorus. And so he's looking at his fertilizer prices going so high that he's actually saying, "I can't make any money. It's not worth it to me to even feed my cattle." If that's the case, we could see food prices skyrocket in the United States, even though they already have. We may have not seen anything yet. And of course, the war in Ukraine is now causing Europe, which is the third thing, to very likely go into a recession. The European Central Bank said the likelihood now is great that they're going to have a recession. They're our biggest trading partner. And if Europe goes into recession, then our ability to sell to these people who are in recession is impaired, and that could hurt profits in this country for companies that are exporting their products to Europe, our number one trading partner. And if that were to happen, then profits would come down here in the United States. As we've always said, what drives the price of stocks for the most part is profits. And if profits are down, stock prices go down with it. Okay, if you haven't had enough, let me go to number 4, which is the Fed. So the Fed has decided that they have a mandate, right? Their mandate is that they are in charge of 2 things. One is inflation, and the other is jobs and growth of the economy. Well, they've prioritized it. They made it very clear. Their number one priority is controlling inflation, because if they don't control inflation, there won't be any jobs and there won't be any growth. So they got to take care of that beast first if there's going to be the other. Well, they announced this week that, oh goody, we're not going to raise 75 basis points, we're only going to raise 50. Well, that's still bad news, which is why we saw the big sell-off on Thursdays, because wait a second, 50, that's still bad. Oh no. So the people that bought on Wednesday because yay, it's not 75, well, those people got punished severely on Thursday. Be that as it may, the antidote to inflation is to reduce growth, reduce demand. And so they're going to raise interest rates to do that. If you reduce growth, you reduce profits for companies. If you reduce profits for companies, it affects the stock market. So again, you've got that headwind. And then there's another one that I haven't heard very much talked about, but that we'll see headlines about, and that is that the dollar has become very, very strong. Now, many people worry about, is the dollar going to collapse? Is it going to get weak? In times of adversity, in times of fear, what does the world do? They bring their money to the United States because even though it may not feel like it, we are the most stable economy, the most stable government in the world, and the safest. So they bring their money over here, essentially buying dollars. And when they do that, they drive the price of dollars up. Well, that may sound like a good thing. It makes our ability, because the dollar is stronger, to buy foreign goods cheaply. So we've seen bookings to go to Europe increase because you can go to Europe cheaply. But the reverse is that foreigners buying stuff from us has gone up a lot. Versus the euro, it's almost 20%. So the cost of our services, our goods to sell overseas has become 20% more expensive. And if things are more expensive, people buy fewer of them usually. And if that happens, then our companies that export are also going to be impaired by all of this. So there's a lot of headwinds. And so in our view right now, the risk on the downside is significantly greater than the potential on the upside. And when you have that kind of an equation, it is, in our view, incumbent upon you as an investor, as a person who's contemplating retirement or who is already retired, to consider whether you should be in this market or not, whether you should take your marbles and protect yourself. Now, as you know, we have a strategy we call Invest and Protect. It told us to tell our clients back in November of 2007 to get out of all stocks, all equities, and we told people to stay out for a year and a half till June of 2009, and when the credit crisis came. And so our strategy is designed to help people over 50 who are retired or retiring soon to have their money last as long as they do. And we want that for you. So the only way we can help you is if you get in contact with us and we talk with you. So what I would encourage you to do is to visit with one of our retirement planners and have them go over with you how much risk you're taking, our Invest and Protect strategy, what we think you should do. And we'll do all that with you at no charge or obligation. Our goal is to help as many people as we possibly can. And if we can do that, we've done a good thing, and we'll be taken care of in the process. So again, we can't help you if you don't let us. So go to our website, rpoa.com, click on Meet with an Advisor, visit with one of our people, avail yourself of our content.